Some make sense, some doesn't. Frankly, there's some lunacy in the market, which I would put, even though I own it, Nikola, which is hydrogen trucks. Stock was up 134% yesterday, 100% during trading day, and another 34% after the close. So maybe it deserves to be there. We heard Jeff Ubben come in and talk about it, brilliant investor. But to me, that's lunacy. That shouldn't happen. So I think there is some speculation. The airlines, again, I mean, those companies are still, as far as I can tell, pretty much close to bankrupt. We heard the CEO of Boeing say that want to go bankrupt. I own those as well because I'm playing the speculative trade. So there is some lunacy. But then again, when I take a look at not only the Fed balance sheet, but the ECB balance sheet, what I see is similar to what occurred in 2008. So the Fed balance sheet back then went from $850 billion to $4 trillion. The economy, GDP, was at $15 trillion. Now we're seeing the Fed balance sheet go from that $4 trillion to about $9 trillion, and it's going to go higher. With an economy, it's at $21 trillion. So that's what people are betting on. They're betting on the reopening trade. The jury's going to be out, in my view, for another couple of months. So I still think the market has upside. And if I had to look out a year or 2 years, which I do, we're going to be higher. I can't tell you whether it's Jeremy Lin, in other words, a flash in the pan rally, or if it's more like Tom Brady when he joined the Patriots, a long-term bull market. So that's how I'm looking at it right now.
So, Shannon, I want you to listen to what Jim Cramer said on Squawk on the Street about where we are, some of the concern about this speculating in the stock market driving so many stocks maybe higher than they should be. Let's listen.
I've never seen so many games played with stocks, which is that, hey, we're taking this one up today. We're taking that one up today. They used to do that in Japan in 89 and 90. We know how that ended. So please be careful when you see a reference in Twitter which says we're taking up Hertz or get on board the Chesapeake train, because you're not going to be the one who makes the big money. You're going to likely be the one who loses the big money. And I just want to warn people.
Shannon, your reaction to what Jim had to say?
I think investors are reacting to what we've been telling them over the last few years, Scott, which is to buy the dip and to think about equities being a longer-term capital appreciation story. And unfortunately, I think there's this enthusiasm and then there's this barbell in the market right now where you are still adding to some of your technology winners, maybe not to the same extent. We've seen some, modest underperformance recently, but you're also barbelling that with this trade where you're trying to catch, these very undervalued stocks and add them to your basket on this speculative trade. So, I talked about this yesterday with a colleague of mine. If you think everybody's going to go back to the Gap just because we're going to start spending money again, we're not. We're not going back to the mall. So I think that there's a challenge here in that we have created this perception that you should always be looking to buy whenever there's a dip in the market, even if there is real competitive pressure on some of these companies. And I think that that's what a lot of investors are getting caught up with. I question the amount of retail flow that we're seeing and if that's really what's driving all of this. But I can tell you that from an institutional perspective, to Steve's point, if you look out over the next 3 to 5 years, I certainly think some of these companies are going to be better and worse off. And I think that those are the decisions that need to be made instead of this barbelling of winners with, the really beaten down stocks that may or may not be able to survive and thrive 6, 9, 12 months from now.